We are back. We are joined in studio by Mr. Eric Musau. Eric is the head of research at Standard Investment Bank. We're discussing last week's government triple play, and we also want to understand what is happening with interest rates and what to expect for the future. Eric, just when we took the short break, we were discussing 12.5 for 15 years. Is that a good return? Is that the best that you can get in the market? And you gave me an interesting perspective. Please help us share this with the audience.
I mean, if a bank needs to borrow, needs to lend out funds, it's probably going to lend out at maybe 13–14%.
Yes.
So if you look at the risk element involved in lending to the private sector versus giving the government risk-free,
yes,
you realize that's not such a bad return,
yes,
in the larger scheme of things.
Okay.
Yeah, so our sense is,
it makes sense. That's a good return.
Sense, yeah.
I like the way you bring in the perspective of, okay, 12.5 is low, but relative to what? When you look at it if the banks are lending at 13 or 14%, and that's high risk because they're lending to businesses and they really don't know whether the businesses will pay back with
and there's a big cost around
operations
around
of it,
because they need to do a risk assessment.
Yes.
They need to monitor.
Wow.
You know, and there's the capital element that they need to write down for that loan over the period of the loan. So there's a lot more work around that instrument versus just giving to government and waiting for the returns.
It looks like we have super smart bankers at the central bank, because what they're effectively saying is either you lend to the government at a net return of 12.5, okay, not 12.5 because you have to include the tax element, but almost 12% return because the tax on these papers was 10%, or lend to the private sector at 13%, then you have to load up the cost of that lending, the cost of human resource, the cost of risk. So your net return on extending the same amount of capital to the private sector is considerably lower. What does this mean then for the economy, Eric? I mean, what do I do if I'm a business that needs capital? Will I ever get, or will you get into a situation where the only investment opportunity is investing and lending to the government of Kenya?
I think our market is quite lucky. I think Kenya government is quite lucky that we have a very developed financial sector that it's able to borrow from. I mean, not many economies across Africa have that benefit.
Yes.
So the liquidity it's able to obtain. And I think the private sector is still able to get some level of access. I think if you look at some of the NPLs that we've seen the banks, you know, bringing out over the last couple of months, and maybe even towards the end of last year, it tells you they need to put in a lot more effort around the credit analysis component,
okay,
in order to ensure that they're able to lend profitably despite the rates where they are, because it's actually possible. And then one has to consider, for example, capital market options for borrowings by, for example, institutions. There's a lot of innovations now. There's the credit lending only apps. So I think there's a large diversity. There's a circle movement. So generally, there's a large diversity in the Kenyan market that you just need to ensure that from a regulatory perspective that it's well managed to be able to serve the economy, and, you know, because at the end of the day you need to create jobs and so forth. Oh,
right, interesting. I mean, it sounds like there's one part of the government that is being very aggressive in terms of lowering the cost of funding for its operations, which is the central bank, and it's tasked with monetary policy. Then you have Treasury, which is tasked with fiscal policy, and it's in a space where it can't collect sufficient taxes, neither does it have the impetus to push money into the economy, largely because of COVID. So it must be a very interesting balancing act, at least in those offices. All right, Eric, let's take a look at now. We have 15-year paper, almost 15-year paper at 12.5%. Our graphics team will put out for us the trajectory for the 364-day T-bill. That has been coming down. It was at almost close to 10% in January, but now it's at 7.5 percentage points. What does this tell us?
Again, it's the same momentum. Generally, the entire yield curve, if you're looking at from 1 year to 25 years, we've seen across the entire maturity, we've been seeing interest rates coming lower. And so I think it's really not surprising. I think the key thing for investors now is to consider if rates were to go down even lower, what options will they have? Do you get back to equities? Are you underweight equities and therefore need to invest a little bit more in equities? What other alternatives are there? Would you, for example, look at global markets? You know, there's real estate. because as a fund manager or investor, you have a whole portfolio of assets to consider.
Okay.
And real estate, again, to a certain extent, is somewhat struggling. You know, do you need to start thinking about, you know, private equity, venture capital, which is quite a crowded area now in Kenya as well, quite well developed. But then you also need the entrepreneurs. So there's a very wide array of asset classes that really need to be explored.
Okay.
But each of them needs a specific skill set, and you know, in what depth can you really pursue this?
Okay.
To get it going. Yeah.
All right, so there's a lot happening. But if I come back to the numbers, Eric,
yes,
7.5 for the 1 year. It's either I invest every year, 7.5, but you're telling me the interest rates are going to come lower. So the return I'm getting on a 1 year could be lower. Or I could decide to invest for longer with the government and earn 12.5%. It could come lower. But I think what we've noticed on the yield curve, which is what you've alluded to, is that the differential for the shorter paper, especially the 364-day T-bill, it moved from almost 10% to 7.5. I don't think the move for the longer dated was that material. But when I paint that perspective, the question is this, Eric, then. Do you get the sense that the government is saying, if you're going to invest in the government, put it in for the long term, or go look for another asset class that is riskier and put money into the economy? Because if it's 7.5 for 1 year versus the Nairobi Securities Exchange, you can get a better return if you're active and you're paying attention. What's the government strategy from a top-down perspective in terms of what we are seeing with the interest rates?
Typically, what they've been trying to do when the rates were, especially for the longer dated instrument, was starting to get a little bit high, they sort of eased off on issuing the longer dated instrument and instead focused on the shorter instruments. And at some point, we're thinking it was a bit of a risk and so forth, but you know, somehow the timing has worked right, so that even as they have these large maturities coming in on the shorter dated instruments, now they can build up on the longer dated instrument at just the right time from a pricing perspective. So I think the central bank is also opportunistic in terms of the way they issue the instrument in order to ensure that they position themselves and minimize the cost of debt, especially local debt, because that's where they really have good control.
Yes. That's interesting. There's so many moving parts, and it really just depends on where you're at. Let's also take a look at what was happening with the 91-day T-bill, which is now at 6.2%. Does it make sense to put money in a 91-day T-bill at 6.2%, yet inflation is at 4.3%?
Well, inflation is still low, I think, when you look at it. And I think actually inflation has been quite under control for quite some time now in the country. 2011 was when it was a bit of chaotic here, but we've not had too much risk on the inflationary side. We've had quite some comfort, and that really tells you that, you know, interest rates could potentially
come a bit lower.
Come lower.
I don't like when you say that, because for the 1 year, I'm like 6.2 is so low. So if it's going to get lower, I might as well. I mean, lower. I mean, if you look at globally, you're seeing other countries with negative interest rates. Fair enough. Fair enough.
Of course, there are different structures of the economy and so forth. And if you have a slowdown in the economy, typically interest rates will come lower. And the idea is that governments will try and pump in money into the economy in order to get things working. Is that something that happens in Kenya? How does the government pump in money into the economy? Well, in a way, when you look at, for example, government paying, for example, the suppliers, and those payments came in, that was in a way sort of increasing cash into the economy. But if you look at also the tax component, you saw VAT reduced from 16 to 14%. Corporate tax and also the top income tax reduced from 30% to 25%. In a way, that's really ensuring that there's really more money in the economy, and also taking on wider deficits. So like this year, we're looking at a fiscal deficit of probably 8.5%. That's pretty high. That's pretty high. Historically, we've been probably between 7 and 8%, which is still high, because they've probably had a target of somewhere between 5, 6, 7. 6 in all the medium-term papers. 5.5. They always revise their targets, over time. Of course, there are issues around absorption of that debt, absorption element, but you can tell this year they're sort of pushing in a little bit. And I think when you compare it with other African economies, it's not surprising, and I think it could be accommodated in the context of what's happening globally and in the context of COVID.
Okay. Also like that you bring in the context of what's happening globally and other economies, because we might just look at Kenya in isolation and say 6.2% is low, but I was also looking at the Nigerian statistics. They're close to 0.1% on a similar tenor. So certainly we are getting, our rates are much, much better than what we are seeing in other countries globally and locally. For the investor, for the investor, yes. Certainly for the investor. I'll come towards the tail end and just briefly talk about the debt. So now that we've looked at what happened last week, and you're telling us to keep expecting these issuances, and you're telling us overall interest rates could come down just because of what is happening at an economic level. Secondly, Eric, you're telling us that the outlook for inflation is more or less stable. Is there any trigger? Is there anything that could make inflation move to double the level that it's at, or even closer to the higher limit for 7.5% that CBK gives guidance on?
Well, 7.5% doesn't seem too far, even though at this point the risks around food don't appear too serious. We've had the exchange rate weakening somewhat, and that could pose some inflationary risk. But net, it does seem that we're probably going to be within the inflation target, at least in the next 1 year. So I don't see any major inflationary risks in the near term. All right, so inflation is pretty much anchored, but interest rates are coming down. Interest rates could come down. Could come down. Yeah, the all pointers seem like it's going to come down. Especially when you consider that banks are not, if the economy doesn't pick up substantially, then we need credit growth to sort of really pick up strongly to sort of support higher interest rates. So if we don't see the economy picking up strongly, then it's really very unlikely that we are going to see interest rates going up. So then what are you telling fixed income investors? What should they do if I have an existing portfolio? Should I churn my portfolio, or what should I do? And secondly, if now I want to put money again into the fixed interest income space, what papers should I focus on from a strategic level? Obviously, if you invest in the short term, so your 90-day, 180, 365, you face reinvestment risk when that amount sort of comes for renewal. And by reinvestment risk is if you get it at 7.5, you might have to get it at 7% or lower. Or lower with the next auction coming in. So if you have a comfortable interest rate, maybe 10-year, 15-year, or 20-year, and you feel comfortable with that rate, then it's okay to lock in at that point. Of course, you have to monitor the rates quite carefully. And people can sort of price in, you can sort of stagger the portfolio so that whatever remains, you might have no option, because sometimes it's a bid option when you're bidding for these instruments. So you might bid and some money remains, and that's what you put in the shorter dated instruments. But then again, you need to look at if the economy recovers, what happens then? Are you well positioned? Is your portfolio overall well positioned when the economy recovers? Because it's okay to look at the fixed income asset class on its own, but overall you need to look at equities. If the prices start to look attractive, those could be quickest out of the crisis, and they might provide very good upside. And if you're a pension fund, you need to ensure that you position your retirees well, and equities at that point might be a better bet for the long term. So I think it's just a balance that needs to be struck. It's not really an easy option. It's not an easy balance. Because I was going to ask you then, what should my allocation look like today? Because I know when you look at the national statistics for the pension funds, I think some funds are at almost 90% allocation to fixed interest. People who are retiring, people who are probably coming across large sums of money and are investing in Kenya, what would you tell them for the next year, 1 to 3 years? What's a good balance to look at in terms of allocating to fixed income and equities? And if you're going to allocate to fixed income, do you then ask them to take the 5-year paper, or do you tell them to take the T-bills instead and wait to see if there are opportunities? So some of the pension funds which did really well, especially up to end of last year, were the ones which were very heavy on the fixed income side. Because equities were coming
negative,
off.
Yes.
And generally, very little else is invested, especially on global markets, and of course there's this core real estate portfolio. But the ones which were really heavy on real estate, on fixed income,
yes,
did very well, especially up to last year.
Okay.
And they might still do it quite well, especially up to end of this first half. But one has to consider in the slightly longer term, especially now that the prices have come off, especially for certain selected stocks,
yes,
although it could also be for a particular reason, that getting out of the crisis, how do you position the net portfolio to also take advantage of the possibilities? Fixed income might have worked well into the crisis, but it may not work particularly well out of the crisis, especially if interest rates reduce.
Okay, yeah. That's good. So then when you speak to investors, what's the sentiment that you're getting when you look at Kenya? Is there more appetite now for riskier assets such as equities, or are the majority preferring to keep safe? And what are the domestic investors doing? What are the foreign investors doing? What's the balance right now?
We're starting to see more appetite for risk. There's a sense that our economy has come out of this crisis slightly better than initially contemplated. If you look at the key sectors, especially around agriculture, horticulture, fruits, tea, those have done reasonably well. Of course, you're going to hurt quite significantly on coffee, on things like transport and tourism. But if you look at, for example, diaspora remittances, those have come in quite in a quite a solid manner.
Yes.
So you can say in a nutshell that our economy, despite the crisis, has done reasonably well. In fact, we're probably going to expect a growth for this year, which is quite unusual if you look at what's happening globally. So we're seeing a little bit of appetite from a risk perspective, obviously quite selective.
All right, selective.
Yeah.
So then it looks like it's really up to you to evaluate where you stand and decide what your 3-5 year investment horizon is, and see where you see the opportunities.
Yes.
I think that's probably a better way to look at. And I also like that you say post-crisis it's better probably to focus on riskier assets, and that would be equities. What other asset classes is looking promising? Is there anything in real estate? Are you seeing opportunities in the private equity space that are becoming apparent?
I think it depends how you tap it. I mean, real estate, there could be opportunities. Of course, there's the affordable housing, but it has also its own challenges around it, and how do you capture it? Private equity, venture capital, also, how do you capture that? Do you invest in a fund which has expertise to sort of get these companies? And even then, some of them have been, valuation is an issue.
Yes.
How do you value continuously in your portfolio every year as your pension matures and so forth? How do you value those assets? These global assets, you need expertise. Typically, we've had, you look at global funds and you put in them. I think locally we have the local licensing.
Yes.
And we're having local licensees being able to trade global assets. So I think there are different opportunities, but I think at the end of the day, one has to look at the expertise and being able to tap into those opportunities.
Okay,
yes.
Fantastic. Yeah. We take another short break. When we come back, now we're coming to the tail end of the conversation. Fixed interest, we are seeing the opportunities there, but there has to be a balance between low risk and high risk investment opportunities, especially if you want to capture the upside post the crisis. What would you like to know? We are here to facilitate this conversation on your behalf. Our SMS line is 20146. We're also running live. Reach out to us on Facebook, that's Metropole TV, or on other social media platforms, Twitter, Instagram, either Mbithe Mwema or Metropole TV, and let us know what you'd like us to answer. We'll see you after the break.